I'm Richard Hooper and this is SatTV Week. Now I'm here with PJ of SpeedCast. PJ, a lot of acquisitions that you've made recently. How has that strengthened SpeedCast's position?
Good morning, Richard. Thank you for having me. We've made another 2 acquisitions so far this year. UK-based company called Hermes Data Communications, very much focused on servicing the oil and gas industry. Fantastic experience doing so. People on the ground in key difficult energy markets, and they really bring a new level of expertise and experience in that industry for SpeedCast. Together with the appointment of Keith Johnson as the head of our energy division last October, and adding to that the scale, global reach, and financial strength of SpeedCast, we feel we're very well equipped to service that industry moving forward. So, very targeted acquisition, but a very important one for us as we move towards servicing the oil and gas sector on a global basis. The second acquisition we've made, and that closed May 1st this year, so just over a month ago, is a Paris-based company, back to my hometown, called Geolink Satellite Services, focused on the African continent. We see a growing demand for services into Africa from our customer base in Asia Pacific. We've had difficulties servicing those requirements as our capabilities in Africa are limited. Geolink brings a wealth of experience in the African continent, providing services in over 20 countries there, and they will help us fulfill the needs of our Asia Pacific based customers into Africa. So also an important development for us.
When you're making acquisitions of the type of level you are, does integration become a problem?
Well, all the acquisitions we've made so far, the 7 companies we've acquired so far, are companies that were not for sale. They are companies that we selected because of the way they come and fill a gap in our approach to the market. There's a very significant level of complementarity. Those acquisitions have been driven by revenue growth, revenue synergies, not by cost synergies. In most cases, they were owned by manager owners who didn't have an intention to sell. So there is an exercise to go through to convince them to sell those companies. And doing that, we're already talking about how we're going to integrate. How is this company going to fit into SpeedCast, and how is it that together we can achieve more than if we're separate? And I think the fact that we have to think about the integration before doing the deal, the fact that this company are chosen for the fit with our business, the fact that culturally also we make it a point to understand the culture of these companies, and all the companies we've acquired had a similar culture to SpeedCast, entrepreneurial, team-based, very focused on the customer. And the fact, lastly, that they were growing companies making a profit, so we've never been into turnaround situations. All of this together has made the integration so far very smooth. With Hermes, it is the first time that we're integrating a global company, so a bit more work, but a very exciting time, because, as I said earlier, with Hermes, we really have a very powerful play into the oil and gas sector.
Now, with the advent of new technologies and systems like HTS, how is that changing SpeedCast's approach to the market?
Well, it's satellite capacity of a slightly different nature, but it remains again about what capacity should we use to deliver the right bandwidth, the right availability, the right price to our customers. So with HTS, we've been doing quite a bit of work over the past, I would say the past 2 years. We're already using an Avanti satellite to provide services in Afghanistan and Libya. We've started working with O3B, where we're seeing quite a bit of traction in that sector, both in terms of tracking in the Pacific, as well as providing services to the energy sector. I think the low latency feature of O3B presents some real benefits to some of our customers, especially in the energy sector, customers that are operating real-time applications. We have signed a Tier 1 distribution partnership agreement with Inmarsat for Global Express, both maritime and enterprise. And lastly, we're in discussions with a number of operators, including Intelsat with Epic, to see how we can overlay some high throughput spot beams over our global Ku-band network in areas where there is a need for more bandwidth because of the concentration of customers, or because we have customers that need more bandwidth for their jobs.
In the Asia Pacific, well, Asia as a whole, what are the sort of demand trends that we're seeing from products?
Well, generally speaking, in our industry, bandwidth utilization is going up. Whether it's automations of the mines, the emergence of the digital oil field, the bridging of the digital divide, there is a need for bandwidth in rural areas of Asia, and there are a lot of rural areas in Asia, and there is a need for more bandwidth in a lot of the industries we're serving, as digitalization drive the need for more data exchange. So we're seeing that across a lot of the customers we're serving. I would say, in terms of rural connectivity, obviously the cellular operators are at the forefront of bridging the digital divide. So we see cellular backhaul remaining as a strong growth opportunity for us. In existing markets where we've been working, like in Southeast Asia, South Asia, Pakistan, Afghanistan, Indonesia, Malaysia, but also in new markets like Myanmar. Maritime in Asia will be a strong growth engine. The penetration of VSAT into the maritime sector in Asia is lower than in Europe, but we see countries like China starting to get to that point where putting VSAT on board vessels is part of their agenda in the coming years. So maritime, we see that as a growth area as well. And in general, our enterprise customers need more bandwidth to carry on their work. So we can be optimistic about the growth profile in the region.
Some commentators are saying that the satellite industry is going through a challenging period. Do you agree with that?
If I look at the SpeedCast business so far, not really. I think our industry, and that's not new, because that's the whole story of SpeedCast for the past 15 years, has a need to constantly adapt itself, constantly reinvent itself. Our growth engines today are very different from 5 years ago. 5 years ago, our business was booming thanks to Afghanistan. Well, it's not the case today anymore. 10 years ago, it was trunking in countries where today there's fiber. So that business is gone as well. So it's about reinventing ourselves. This need for constant adaptation. But I think there is growth potential, no doubt about it. Growth potential in two ways: growing with the market, but also taking market share. As I think at SpeedCast, we've built a name for the quality of our services, the quality of our support. I think there are certain things we do better than others, and we've seen us growing faster than the market in a number of industries or countries. So we're also gaining market share. But in terms of challenges, I would say that there's been an economic slowdown with, in particular, the resources sector. So we've seen some slowdown in certain areas. Nothing major, because there are still big projects and we're still seeing attractive opportunities, but a small slowdown. These times are disruptive times from a technology perspective. We were talking earlier about high throughput satellites. Lots of things happening in the sky, geostationary satellite, but also lower orbit satellites. Lots of things happening on the ground with the ground technologies. Lots of things happening in the value-added services. So it's difficult to keep up with everything and to be able to dedicate resources to work on all these areas. Having reached the scale that we have today, that's one of the competitive advantages we have. We have the resources to work on all those fronts. But certainly disruptive times from a technology perspective. The last point I'll make, and I think this is a point I've made probably every year we've been together, which is we use the same satellites as our competitors. We use the same technologies in most cases. We develop a few things ourselves. We integrate things, but overall, I wouldn't say we have a high level of proprietary content in our solutions. What differentiates us? It's our people. We're in a service business. It's a people business. It's the attitude of the whole organization from top to bottom towards the customer, towards customer satisfaction. So a big challenge for us is to retain talents and attract talents. We've been doing that well so far, but we need to continue doing that because it's paramount to our success moving forward.
PJ, thank you very much.
Thank you.